How to be a market maker. MMT's 11/26, 2011, 900 AM and 903 actually. We're taking a look at how they marked down the call side again at 97% on that 575 call MMT. On the 580 call, they got marked down 90%. Last print was 5 cents here, 5 cents here. So once again, having this in the database, you can see the 590 call got marked down. Just on Friday alone was 75%. Last print. Let's take a look at that $600 call that got marked down, because it did. And that means that all of the markdowns on this side of the market that, once again, you can see will go into what the put side did. But they, from the 11/25 expiration right here, you'll see that where the put had gained 21%, that the $600 put had gained that amount. The 580 put printed plus 66%. Okay, the low was 650. The high, of course, was 1660 in the last print. So there was a $10 markup in the put side of the market there at the 580 put on Google. On the 575 put, you can see that the low was 2.77 and the high was 11.61 right here, here and now. So that's that put side. The other thing that I would like to emphasize with my MMTs is that there was still a low of trading that $600 put in the money. And this isn't your standard, okay, here, I'm going to learn how to trade options and terminology and all of that. You can get that on the internet anywhere. That's been done forever. Getting and making the market, though, that is something that people don't do live interaction with during live market hours. This is a Saturday training session, and once again, MMTs, there was, like, even if you're buying 10 contracts intraday, that low was 27.48. There is a $10 move here. Total volume, though, was only that. Okay, but let's take a look at that 605 put, 32 to 40. That's a narrower spread, so we know that this 600 was the one that had the $10 premium as we were trading this $600 put and covering this on a daily level. The other thing about it is that the put side has been playing a lot. We've been looking at this other puts that go way out here. We will start with this part now today, and we will be doing the December, this calendar Monday ending through Friday, which will be the last few trading days of the calendar month of November 2011. Happy Thanksgiving weekend to people, and we hope that everyone enjoyed their Turkey Day and that you came out ahead on the bid and ask with your families, of understanding what that Thanksgiving Day is all about. It's about giving. That's what we do, is we let you know what the Grand Theft Auto that takes place every day called Grand Theft in Options, and how they mark bids down and how the public, unfortunately, has a hard time dealing with it. Nonetheless, we're going to keep it sweet, and what we're going to do, Google last print was 563. We will start with the weeklies, and once again, we'll look at some of the deflated prices on the call side for the week. The put side is paid out. We will be doing all of our examinations very carefully as we have gone over here. This is the call side in red on that net change percent down, but you can take a look at where some of these things had closed, MMTs, as we always do, making a market within the exchange model, meaning the equities are one side of it, but the option side, the true way is that there is no model year to date, no matter what you think. And all the terminology in the world isn't going to protect you on how they steal bids from the public, because it's just not. And so it's very, very important that we are a market maker school, which is not your investment schools and all of these other things that people do now. No, it's about how they take advantage of the system and how you too should be right ahead of them on that entry, and you take advantage of the people who take advantage of the public. And when you're getting that entry, at least not everyone is getting beaten down, MMT, and you can come out ahead. I'm going to conclude the monthly strikes here and the amount of open interest columns. And I've already covered that this side of the market has been marked down, okay? And it has. And the call side has been marked down and the put side has been marked up. And what we're going to do is take the strategies now for the weekly and the year-end trade, and most importantly is once the selling is out of the way, with the strong trend on Google, is what are the Google earnings worth? Self-examination, deflated calls, whereas the last couple of weeks with the worldwide turmoil and liquidations that have been taking place is that the put side has been getting marked up, and it has. And the call side that was marked up and inflated is getting marked down. However, with the current events, it will be where fund managers are going to find value. Are they? They are. We're going to be looking at calls that go clear out to January. And we're even going to go further than that. We're going to go out to March. Right here. March of 2012. And we're going to examine the open interest. We're going to examine how much premium they may be stealing or not by using the SMF system we already know. And we're going to apply our skills accordingly. Instead of the markets taking advantage of you, you are being trained as a market maker that when they mark these markets down in certain kinds of ways, like you see here, and that's the call side, the put side, their gains, and we're going to go to call and put inflated and deflated prices, and where the equity is going to find support on Google, and then figure out, well, how much more do I take out of the market? I will point out they've been marking down both on the opening bell. They would mark down the call side and the put side. Then after they mark down this side, they mark it up. When they mark this side down on the open, they printed this as expirations. They went worthless. And you can see over here the 580 put, they stole premium down to 650 on half a trading session yesterday on Friday, 11/26. So that would have been on half a trading day on 11/25. They marked that down, but then they marked it up. They also originally marked these down. If you look in the live videos, they marked these down on the opening bell. We got hit at 30, 40, and even 50 cents and sold them out at $1.30 for fairly decent volume. But it's how they mark the options down. Books don't teach you that because they don't. Using a Black-Scholes model, Gigma, Gamma, and all that other stuff that people, yeah, it's terminology. So what? This bid and ask is a whole different story. And what they did over here with the 585 put, you can see it had a close of 1451. They marked it down too. They marked both sides down, no matter what. And then you can see the high on the put after they marked it down was 2110. There it is, close, but they marked it down. They marked it down and then ran it. But they marked down the calls too on the open, and you got hit and you got out and you sold it back to the public. That's what you did, MMTs. So once again, the full calendar month of December, and not only that, we will be building out and taking a look and looking at January, and we'll be taking a look at March. Okay? And we'll be taking a look at the various different strike prices. There's March. And what we'll be looking at is if Google's earnings are going to be fantastic, and I can go over here and I can steal me a 630 call, and I'm going to make my new market minder list, and I'm going to put that in there right now. Another thing I'm going to put in there is this 635, and I hit show all, and I'm looking at up and out of the money calls, and how do I trade up and out of the money calls? What is the value of buying deflated premium price versus the other side of the market? On the put side is starting to get a little bit inflated, the bear side. They will have to equal, the balances will have to equal out between the call side and the put side. And it's understanding the actual devaluation of the premium, the price premium that you're buying, and how do you trade leaps, and you know, what is the real way of making a market versus trying to use outdated models that don't work anymore. Things have changed, and we're going to go find us and make us a market. And one of the things we're going to be looking at is we would be looking at this $600 March. But we're also going to keep looking at, in case Google wants to go lower, we're still going to look and see where the well, we'll start with some 540 puts for next week, some 535 puts for next week. We'll also start with some 530 puts for next week. And in the shorter term here, as we get rid of 1125 is over. So right now we have these December 2s in here. And here's the 540, 535, and 530. So here it is. 530 put, 535, and the 540. So we have that there. Now, having said that, let's go over to where the last print was, and let us make sure that we can understand that right below the strike for next week is we put in that other put option there. And that's a 560 put right here. Here it is. Okay. And there's the low, 530 to 550. That means there's a nice spread in there for a market maker entry. And books don't teach you how to get these kinds of spreads using the right entry price, a discount price to the public price. So as long as that discounted price is there, that's the wholesale. That's the way that you're able to make your adjustments and sell out. And then at the same time, because they mark both the put side down and call side down. So we know that they mark both sides down of the market. And both levels at some point become weighted at a wholesale price. That's the gift of trading the December, the January, and the March of 2012 contracts on Google. And how do I trade these contracts through year end? Right down to the last nitty gritty of the December calendar month. And we have some right here. 12.2, 560 put. Another one that you're going to want to look at, MMTs, is going to be this one. Let's make sure in the money, 570 put goes in there. But also, let us not forget that the 565 call, right below in the money 560 call, let's take this 555 right down to the pricing controls. We will price each one of these markets out now on the 12.2 list, which is gaining momentum. Look, here's your put side. Here's some calls. Okay. They're all right here. Some are in the money calls. Here, let's do this. Let's take a look over here Let's throw in that $600 call. Not only that, if you really want to get me excited, let's see how deflated the premiums are in the next video, and I'll give you a sample of what that next video is going to look like. Like right here is a put option that's gaining some momentum. So we'll have to come back to this one. But it's a January 1000 put, and it's about ready to break out. We'll cover that in a different segment. What I do want to show people here is exactly what up and out of the money would look like. There we go. Here we go. We're down here now. So let's take a look at the previous prices. Let's take a look at these weekly prices that have been written by the exchange model. 240 down to 40 cents. $2 premium have come out. This is what we're going to do for the rest of the day. Is 44 cents is the low. I can afford to buy down here because the retail for this weekly contract, it's a $12,600 call, but nonetheless, it's been marked down to 44 cents. How to trade Google options, how to find deflated premium, how to understand the stockmarketfunding.com pricing options pricing control systems that we use, because we do. We will give you a snapshot that in our system here we have ways of deciphering prices, meaning that we don't guess. And this is the actual price movement of Google in the equity. So the equity moves a certain way, and then it populates a mathematical equation, and they always like to still, because if you look at the columns right here, if you go over here, you'll see that they like to steal this row, 30% down, marked down. And they, so depending on where Google is, we could have a whole line coded that tells us what it's worth, but they could be marking that market down here. And this is where we'd be starting our bids, down here, using our system. Of course, only the MMTs that are here use it. You can see the Google trade. That was when all of this started. So they have a new close now, but you can see 580, it dropped the delta to 570, and still dropping and closing at 563 in our system, which populates the option brain. And this is where we are able to establish how much premium that they take away from the public. How much of it do they mark down? They're always marking the calls and the put side down. It doesn't matter. And it's how to get your limit orders, your bids with your stop management, risk management loaded, so you have the right entry, exit, and of course mandatorily your stop market order, and rebalancing and then getting new entries and where markets will be made. However, you have to understand where they're going to steal price premium. These are the options. This is the row. Let's say if it was up here, they're not marking the premium here. They're actually taking their premium way down. Well, this is one that just expired, but they took the premiums way down here, right here, this row. Well, this row and higher. So you went like this, and the 1125, you traded within here, but the actual equity price print in Google was totally different. I mean, at 561.33 is a low. They stole where the premium should be. They stole the premium because that premium should have opened right here when you had your intraday lows at 565 on the equity. What they did was they took that 395 and they marked it $2 below there, as if the equity was trading on the opening bell at 561 when it was not. It was not trading that way. But notice how the intraday low at late in the day, it was right there at that price. They opened the option there and then ran that thing right up. in markets, and these are option markets. We are market makers. This is not day trading. We own it. It's how you make markets between the public as a buyer and a seller of the call and a buyer and a seller of the put, both, in relationship to the equity dollar price movement in the equity. Rather, and you're trading the put side, but how do I trade options? How do I understand options? Um, all that terminology isn't going to help you. No. The math and understanding how you make a lower end of a market to buy and a higher end of a market to sell back to the public. So you're constantly selling and you're constantly buying. And therefore, if you're constantly buying the call side deflated and selling over here, you're always selling and you're always buying. You're buying the markdown here, you're buying the markdown here, but once you get your markdowns, you're always selling back to who? The public. The public doesn't have this model out here, and it's an options model, and it works. And if you don't doubt it, hey, that's on you. You can come and join our free 5-day trial and learn how it works when it's everything we do is in real live market hours. That's another thing you don't get at other places. But we're a market maker school, and we're the only one. And we make markets between the public and buy and sell transactions and how they still premium relative to the price action of the equity and which way the equity is going, what side of the put side is going to print, how they mark them down. Look, hey, they marked that thing down. It closed at $9.90. They marked it to $6.50, but look at that's a $10 markup. Yeah, and that's money. That's money. Getting that low entry and getting that books, CDs, and all that other crap and terminology is not going to show you how to do that. It's not.